Hi folks, part 3 from chapter 9, a little bit more about accounting methods. So basically, as we know, you can be cash, recognize income when it's received or accrual, okay? Generally when it's earned or when it's received, whichever, we know the rules regarding that. By the way, adopted with the first tax return, so you have to claim your methodology on your tax returns. Large corporations, partnership, have to use accrual. Now you can, if your taxpayers satisfy the gross receipts test, you can use the cash method, and that's that under $30 million deal. Okay. So cash, I think we know this already. Income when actually or constructively received, you recognize expenses when you pay them. Why should you use it? Flexible, simple. It has poor matching for income and expense. We know that's why accrual exists. And again, the gross receipts test. So you could use it, basically if you would be considered small business under that 30 million. Now, accrual income, basically what we study mostly in accounting. Income is recognized when it's earned or received. The all events test, okay, so all events test is recognize income when all the rights have transferred over to you, okay, and that the amount can be determined with reasonable accuracy. And if you remember in intermediate, they have that 5-step process that you do. So it can be the date of or service of sale, payment is due, payment is received. The earliest of these dates typically is when you'd wind up counting it. Okay. So question number 5 for chapter 9. Which test for income determines the amount of income will be included in taxable income for the accrual method of accounting? Method taxpayers. UNICAP test, the Spanish test, the all events test, or the Proctorio test? All right, folks. Hopefully you get that one right. All right, so here's an accrual question. Ben provides consulting services and bills ACE $12,000. ACE disputes the amount, claiming that $8,000 is the proper amount. How much should he recognize under the accrual method? Well, under the accrual method, you got to remember what reasonably estimated, and the only thing you could claim here is the $8,000. Now maybe later on down the road when Ben and ACE get back together, they can hammer this out. But for the moment, it's $8,000. Okay. All right. What about prepaid income? Basically deferred income. So advance payments for goods or services, we've seen this. Deferred recognition, unearned revenue or deferred revenue, okay? By the way, not applicable to payments relating to rent or interest income, okay? And again, counting less cannot be changed without permission from the IRS. So if you decide for some of these things like having to do with the rent and interest, once you've chosen it, you cannot change your mind without IRS approval. Okay. So here's an advanced payment example. Ben provides dancing lessons. On September 30th of this year, he received $2,400 full payment for a 2-year service contract. I guess basically $100 a month. What if he's cash method? How much would he count? What if he's accrual method? So here he received the full payment. So if he's cash method, what's going to happen? He's going to wind up taking it all this year because he's cash method. He got the money. If it's accrual method, he can elect to defer advances for services for a year. So he'd recognize $300 because it's only September 30th. It'd be October, November, December. 3 out of the 24 months. Okay? And then the next year, he would have the $2,100. Okay? Okay. Income can only be deferred for 1 year. Okay, can only be deferred for 1 year, so we'd have to recognize the remaining. All right. What about inventories? Okay, they're generally accounted for under accrual method. And again, it says if sales of goods constitute an income-producing factor. Okay, if so, they must be used accrual method. Hybrid applies to cash method taxpayers who use accrual for sales and purchases. By the way, when I had my businesses, that's what I did. Okay. Let's see, what else? UNICAP. UNICAP stands for Uniform Capitalization. Now, what that's all about has to do with the indirect costs allocated to inventories, not expensed. So now, not selling, not advertising, not research, but basically full absorption costing, right? So any of that overhead stuff, okay? Now, again, exception for business that qualify under gross receipts, but uniform capitalization means that especially if you're building something, all the things that are part of that inventory, all part of that cost of goods sold, if you remember, hang on, direct materials, direct labor, manufacturing overhead, right? All of this stuff right here. That's what they're talking about. It all gets capitalized. Okay, so by capitalized, it's part of their inventory on their books. That's what they're getting at. Inventory assumptions, I'm sure we know these. First in, first out, last in, first out. By the way, same method for financial and tax record. This is called book tax conformity. Okay. And again, you have to use the same method for both tax and financial income. And then specific identification. If you remember this one, it's item by item. Normally for very expensive items, cars, jewelry, things like this. Okay. So again, this is kind of just basic financial accounting stuff here. Accruing business expenses. So again, the events have occurred to establish the liability to pay. Okay, so we're going to accrue the liability. It means we're recognizing the liability and the expense. We're recognizing the expense and creating the liability to pay it. And it has to be determinable with reasonable accuracy. Okay. Notice here, reserves for future liabilities are not allowed, so you don't make reserves for that. And the economic, whatever it is, it has occurred. It has occurred. That's the requirement. Okay. And then economic performance. This is for accrual method taxpayers. Okay. So the performance occurs as the taxpayer provides the goods or services. So what they're getting at here is that the exchange, that economic exchange, has happened. Okay. All right. Taxpayers with goods and service when the goods are provided. Okay. Economic performance is otherwise expected within 3.5 months of the payment. Okay. So anyway, it makes sense. And then interest and rent occur ratably as it happens. Ratably means as it happens. So basically, when it comes to this stuff, your rent and what have you, time is the element in economic performance there. So here's an example. Ben signed a binding contract for Peter to provide Ben with repair services. Ben paid $1,500 to Peter and owes an additional $6,000 on the contract. The repairs will commence late next year. When can Ben claim the deduction if he uses the accrual method, right? So Ben paid $1,500, but the question is, when can he take it? Okay. Okay, the all events test is satisfied. He signed the contract and owes the money. However, the service provided to the taxpayer in economic performance is as the service is provided. So he has to deduct the $7,500 next year. Okay. All right. And note, there's a couple notes here. Prepaid expense that does not qualify for the 12-month rule because economic performance is not met. Okay. He said Ben could deduct everything if he expected it to be all done within 3.5 months. Okay. Okay. But that's not what it said. It said late next year. Okay. If they'd have said by March of next year, he could have deducted it. Okay. All right. A little bit more about choosing an accounting method. So a permissible method is adopted by using and reporting the method for 1 year. I don't know. Impermissible method by using the method for 2 years. I don't know. Why would anybody do that? I don't know. Generally, you want to change your method. You need IRS permission. Sometimes the change is fairly automatic, but permission is necessary if you're using an impermissible method. So, again, I don't know why anybody would do that, but it says you got to get the IRS approval if you're doing something wrong to begin with. All right, folks, that's actually the end of the chapter. We'll be back with another chapter soon. Talk to you later. Bye-bye.